Hello class and welcome to our lecture number 14 and I'm your instructor Dr. Jumail. Okay, in our last session we were talking about we covered the plant assets and then we covered the current liabilities. Our today's agenda is today we are covering long-term liabilities. So long-term liabilities whose life is more than the accounting period, more than 1 year or the accounting period, right? So mostly they are bonds payable and notes payable issued for longer period of time, right? So let's just talk about our learning objective for long-term liabilities, that is account for bonds payable, notes payable, and interest expense. Remember, interest expense belong to income statement. An income statement closes at the end of the year. So it's a current expense, current year expense, right? So since interest are on our liabilities, so we will be discussing here as well. Okay, so don't just confuse that this interest expense is a long-term liability. No, my dear. Interest expense is income statement item, not even a balance sheet item. Interest payable is balance sheet item. Okay, so there is a difference between interest expense and interest payable. And interest payable normally are current liability, not the long-term liability. Okay, so what is bonds payable? So basically, it is a finance issue. If you are learning advanced financial management or at the end of the finance, introduction to finance, so we'll talk about bonds over there extensively. What is future value? What is present value? So we'll talk about over there. But I hope some of you already, have the idea what is present value, what is future value, what is time value of money. So we will talk about this bonds payable in accounting purpose, recording purposes, accounting purposes, this kind of stuff, right? So the introduction of the bond. So bonds payable, normally we call this bonds. In short form, we call this bond. So bond is a debt of issuing company. So why we issue this bond? Basically, there are two sources of funds. One, that we collect funds from our investors, from our shareholders. So we call this equity, owner's equity, right? And the other sources of funds that we ask from public or from bank to give us loan. And on loan, we have to pay interest, right? So introduction of the bond is, it's a piece of paper on which company name is written, its principal value is written, what is the face value, what is the future value of this bond, whoever holds this certificate, what will be the value, right? And maturity date, if somebody has this certificate, after which time this certificate is mature, which means after which time we will be able to get our money back. Of course, there are going to be interest rates, and of course, there are going to be payment dates as well, right? For example, some says we are going to give you interest quarterly after every 3 months, or we are giving you interest after 6 months semi-annually, or we will be giving you interest on annual basis. But remember, interest rate is always given on annual basis. Annual basis, right? So 9% if interest rate is given, if 9% interest rate is given, what does it mean? It means 9% annually. this is given, right? But if the interest rate is given semi-annually, so it means this 9% is annual, but will be paid you in 2 installments. It means 4.5% on every 6 months, right? If quarterly, you divide it with 4. After every 3 months, you will be getting those. But the denotion is that this 9% rate always given in annual terms. And after that, the payment structure is given to you. 9% annually. Annually means the payment we're going to give you annually. 9% semi-annually. Semi-annually means 9% going to given you in whole year. But how we are going to pay you that 9% in 2 equal installments. 9% quarterly. It means this 9% going to give you whole year, but how we are going to pay you in 3 months installments, right? So that is a key point here. Now the types of bond, there are 4 types: term bond, secured bond, serial bond, unsecured bond. So term bond, in which terms and conditions are there. You will be given your money back after 3 years. Interest payment is going to give you after 3 months, 4 months, 4 months, semi-annually or annual basis. Serial bond, in which there is some kind of series. For example, you will be given interest plus principal. So you have heard from our previous lecture, current portion of long-term debt. It means you are also paying interest and you are also paying your principal back. So there is some kind of series on that one. Secured loan and unsecured loans. Secured means when you require loan from the public, you gave them a certificate. There is some collateral. For example, the building, if we are not able to give you back your money, we will sell this building and give you your money back. So there is a security behind that. We call this secured loans. Unsecured loans. It means it is up to the discretion of the management. They are asking loan, but there is no security behind that. So normally when there is no security, their interest rate is higher. Higher the risk, higher the return. So if a company asking unsecured loans, so those who are providing loans, bond holders, they demand higher interest rate. Right? We also call this subordinated loans, which means, for example, if I already issued one loan against this building, but now I require more money. So I said, okay, I am giving you, again, I'm issuing you a loan and I'm giving you those certificates, but this building is collateral. We call this subordinated loans, which means if I default, first priority will be given to the secure bonds holders. The payment will be given to them. And if we have more payments, then those left over payments are going to be given to unsecured loan or subordinated loans. Right? So there is a priority structure in that one. So we are not going deep into that one because that is more of the finance stuff. So we stick to our accounting. So that was just the introduction. Now, some features of the bond prices, like we purchase commodity. Sometimes its price is higher, sometimes its price is lower. So it depends on demand and so recall our discussion 1 or 2 years ago on economics, demand and supply. So when demand is high, price is high. When supply is high, price goes down. right? So that concept apply here, you will understand what's going on. So bond prices are quoted at a percentage of maturity value. So these are basically quoted on the basis of percentage value. So normally one bond price is equal to 1,000. So 1,000 is 100, which means if in percentage term it is trading at 100. 101.5 mean it is the price of the bond is right now increases to 1.5%, right? 1.5% above its value, which means price has increased. 88.375, which means price is down by 11.6 something percent. Okay. So this is how we denote in the stock market, rather than we just say that price is increased by 2%, 3%. People don't understand what is the the initial price. So with 22% increase, well, what is the price on 2% increase? 100, 200, 300, 1,000, 1,000. Because sometimes some companies, they issue bonds 1,000 of one security or one certificate worth of 1,000. Some issue 10,000 of one certificate. So 2% increase, we don't know whether it's 2,000 or whether it is 200, we don't know. So the market, they quoted the price in percentage term, right? So if the quoted price is 100, what does it mean? Its selling price is 1,000. So its value on the written on the face of the paper, it is written 1,000, and it is selling in the market as 1,000. So it means the market is in equilibrium, and this price is called par price. We call this bond price is, we call this bond price is at par. Bond price is at par. Look at here. Let me delete all this mess. So if the bond price is quoted as 101.5, it means bond prices are above its price, above its face value. So it means it is selling at higher price. Higher price means premium, right? So where this extra $15 is coming from? So 1.5% multiplied by 1,000, answer is 15. Its face value is 1,000, you add 1,000 here, answer gonna be 1,015, right? So price is above, which means current market price is above its face value or above its par value. We call this premium. So in the market, in the newspapers or in the news, you hear that shares or bonds are selling at premium, or the quoted price is at premium. So you automatically understand that right now the market price of the same bond, which was worth of 1,000, is now trading in the market above 1,000 rupees, right? Similarly, this 88.35